Welcome to the Financial Freedom Podcast, where we interview remarkable people and share strategies for mastering money and living a meaningful life. With your host, Grant Sabatier, creator of Millennial Money and author of Financial Freedom, a proven path to all the money you will ever need.
This episode is brought to you by Topia, the free financial independence tracking app that I designed to help you accelerate your journey to financial freedom. To learn more, search for Topia in the App Store and on Google Play, or visit topia-app.com. That's TOPIA-app.com. Everybody, welcome to the podcast. Very excited to have the one and only J.L. Collins, author of The Simple Path to Wealth. I purposefully put off reading The Simple Path to Wealth until after I had written Financial Freedom because I knew that it was going to be really, really good. And I didn't want to read something that set the bar too high and distracted me and dissuaded me from writing my own book. I sat down about a year and a half ago and read it, and it more than lived up to the hype. JL not only is full of great ideas, he delivers them with love and experience. And this conversation is many years delayed. Welcome to the show.
Thank you so much. What a wonderful introduction. As you and I were talking about pre-show, it's kind of amazing that our paths are just now crossing, considering the work that we've done. But it's an honor to be here, and I'm thrilled that you invited me.
So tell the audience a little bit about who The Simple Path to Wealth is for and why you wrote it.
Yeah, so the origin story, so to speak, and this actually goes back to the beginning of the blog, is when my daughter was young, because I think this stuff is so important in terms of providing the resources to have a really great life with a lot of options. So I pushed this on my daughter way too young and way too hard, and I managed to completely turn her off to all things investing. And as she was getting older, it occurred to me that hopefully someday she'd be open to hearing the message, but I might not be around, so I better get it down on paper. So I started writing a series of letters to her, and I shared them with a business friend of mine. He said, this is kind of interesting stuff. You might want to put it on a blog and share it with your family and friends. And I'd heard of blogs before. I had zero interest in starting one, but it did strike me as a pretty cool way to archive the information. So I figured out how to do a blog. I sent it around to family and friends, as I kind of figured none of them cared. But then, kind of amazingly, slowly but surely, it began to develop an audience. And now it's got a pretty broad international audience. And as you and I were chatting a little bit before the show, you're surprised at how your work's been received. I'm stunned at how mine's been received. I never expected that. But yeah, it's all goes back to trying to convince my daughter that she ought to pay attention to this stuff. And by the way, I'm happy to say, she's 30 years old now and well on the path, so mission accomplished.
Can you talk a little bit about your core investing strategy? I know you're a huge fan of Jack Bogle's work and index funds and VTSAX. Can you talk about why, especially now amidst increasing market uncertainty, why indexing and index funds, and specifically VTSAX, are your tried and true investing strategy?
Yeah, well, first of all, Jack Bogle, who of course has passed away at this point, he lived to a ripe old age, but he is a fiscal saint. The world for us investors is a far, far better place because back in the mid-'70s, Jack Bogle created a company called Vanguard, and he came up with this idea of index funds. And the idea is basically that rather than try to pick stocks that are out going to perform all the other stocks you could have chosen, which is almost impossibly hard to do consistently, if you just buy everything in the index, you will get what Mr. Bogle used to call your fair share. Well, it turns out your fair share is also going to give you higher performance over time than the vast majority of professional managers or the vast majority of people could do on their own. So it's a lot less effort, a lot less work, a lot better results. So it took me personally a long time to come to that realization because I started investing in 1975, which ironically is the year that Mr. Bogle created the first index fund, but I didn't know that. And even if I'd known that, I wouldn't have been wise enough to have embraced it. And I know that I wouldn't have been wise enough because when I did hear about it in 1985, I wasn't wise enough to embrace it. It took me probably another decade plus. Uh, because the thing is that with stock, it's not like stock picking doesn't work. It's not like you're choosing between something that's good and something that's bad. You're choosing between something that's pretty good if you do it well, and I did it reasonably well, and something that's just easier and better. And so I actually achieved financial independence, although I didn't realize it at the time, picking individual stocks. That's kind of my dirty little secret. But my goodness, I look back on it now and how much further ahead and how much smoother and easier and simpler the path would have been if I'd been smart enough to embrace it when I first heard of it in 1985, or lucky enough to have heard of it in 1975. I can't, sometimes I have fantasies about that.
There's a lot of worries now, and I know Jack Bogle, before he passed away, there was a worry that index funds themselves now make up too high a percentage of the market, and that if they get too large, then investing in index fund is really not rewarding the companies that are actually increasing their earnings. And do you ever have a worry, or have you looked into this debate around our index funds themselves getting too large?
Yeah, that's a question that I get on a fairly regular basis. Mr. Bogle addressed it well before he died. He pointed out that, before the creation of index funds, when you go back to pre 75, the early 70s, 60s, 50s, when all of it was stock selection, there was far less trading of individual stocks going on then than there is today, even with index funds, because the market's gotten so much bigger. So there is no shortage at all of trading of individual stocks, which is how the value of a stock is determined. It's individual buyers or institutions, for that matter, deciding at what level they're willing to buy it, what level they're willing to own it, what level they're willing to sell it. So that that's the way a marketplace works, I guess, for anything, is what's a willing buyer willing to pay, what's a willing seller willing to sell it for. There is more than enough of that kind of trading going on to set those prices. So it's theoretically possible that and indexing, of course, has grown dramatically. So it is theoretically possible that indexing could get to a point where that would be an issue. I think we're far ways from it. I also think that as we got closer to that point, what would happen is markets, which are right now highly efficient because of that trading activity, markets would become steadily less and less efficient. And if that were to happen, that would create more and more opportunity for those stock pickers. And so right now, the research is unequivocal that indexing outperforms dramatically uh, active management. But if it tilted far enough in that direction and there were enough of those anomalies in the market, that could begin to tilt, and suddenly you'd have active managers outperforming on a regular basis, and then of course investors would flood into those people, those funds. They might do it themselves. So that, I think, would naturally tilt the pendulum back in the other direction. So that's a long answer to your question. The short answer is I don't think it's a problem now, and I don't think it's going to be one.
So what about bonds? In your book, I know you invest in bonds. I know there's always been, I believe Jack Bogle's traditional advice was invest your age in bonds. As a millennial and I guess increasingly older investor, but still somewhat of a younger investor, I've never invested in bonds. I have a long time for my money to continue to compound and grow. I've never seen the benefit of investing in bonds. I'd rather just take a little bit larger of a risk over a long period of time, given the amount of money that I've saved. Should someone who's younger invest in bonds? When should you start investing in bonds, and why do you invest in them?
As I said, I think Mr. Bogle's a fiscal saint, but that doesn't mean that I agree with everything. And this is one area where I have a different point of view. I think his point of view comes from his generation in a sense. And if you think about it, for his generation, and actually probably, I'm a baby boomer, so for most people my generation, the idea was that you worked, you went to school, you got out of school, whether it was high school or college, you got a job, you worked for the next 40 or 50 years, you retired when you were about 65, and that was your life trajectory. And if that's your life trajectory, then those kinds of old formulas about your age and bonds and all that made some sense. But in this day and age, with the kind of people that you and I write for and that listen to a podcast like this, they may be retiring at 30 and living on their portfolio. And then maybe at 35, they get bored and they wind up going back to work, or maybe they've created some business while they were retired and now they have income flowing again. So in my world, I divide it between whether you're in the accumulation stage or the preservation stage, which is just to say you're living on the portfolio. So if you're in the accumulation stage and you have cash flow coming from most typically your earned labor, and you are putting a portion of that into the market, that's what allows you to take advantage of drops like the one we're experiencing these last few months, right? Because you keep putting your money in and you're buying stocks on sale. I suggest to people that when you're living on the portfolio, you want something to take the place of that cash flow to smooth out the volatility of the market. And that, in my world, is bonds. In fact, I just shifted last week some of my bonds into the stock market to take advantage of the lower stock prices. So for me, it can be an ebb and flow. You might be all stocks, like my daughter, who's 30 and working, is all stocks because she's got that cash flow. If she were to say, Dad, I'm going to take a 5-year sabbatical, then I'd say, hey, you might want to add some bonds so you've got that dry powder to smooth. And then she might, at the age of 40, go back to work and then back to all stocks. And then the final point I'll make on that is those formulas regarding age around your bonds made an assumption that the game ends when you die. And of course, it doesn't. Something's going to happen to those assets. So, especially at my age, but I would suggest that everybody think about it, whatever age you are. I'm not investing just for myself or for my lifetime. I'm investing for the benefit of the charities I support and for my heirs. And they have a much longer time horizon than I have. So the investments I own today don't end with my death. They will have a much longer lifespan.
So let's talk a little bit about inflation that's on everyone's mind right now. Having lived through different inflationary periods, is this something to really worry about?
Yeah, so I think inflation is probably the single most dangerous uh, economic factor to the wealth of the country and to the wealth of individuals in it. And the brutal part about it is that it hurts the poorest among us the worst. Because people like you and me, and most of the people listening to this, we have assets. And those assets, if you own VTSAX, you own stocks, though, they'll be with the fear of recession that drives down the market. But ultimately, stocks are a really good inflation hedge because these are real companies creating real products. They have real assets. They create real services. They have pricing power. So, in all but the worst hyperinflation, people like us are going to be just fine. Um, I lived through the inflation in the 1970s and the early 80s, and I'm an old guy. It occurred to me that probably most adults, if you're under 60 or even under 65, don't have any experience with living with inflation, as it happened when they were, very young. And it's a very difficult once you start going down that track. It's a very difficult thing to turn around. I try very hard to avoid political commentary in my work because I don't think my political views should matter to anybody. I will say, and at the risk of sort of tilting in that direction, that in my view, the Fed should have been doing what it's doing now last year. And I think that it didn't for political reasons because they were still trying to pretend that inflation wasn't going to happen because they still wanted to spend boatloads of money. So finally, the Fed is doing what it needs to do. I was thrilled to see the big interest rate increase, the 75 basis points, which is pretty huge. Now, the downside is because they were late, if they'd been doing this last year, we would have that smooth landing, I think. We'd much more likely. But now we're going to be forced into a recession in all likelihood. And it's interesting to me, they are finally acknowledging that that's probably what's coming down the pike. And that's just the harsh medicine you have to take at this point to bring inflation under control. It's the same thing that Volcker and Reagan had to do in the early 80s when they broke the back of inflation in those days. For a decade, no politician was willing to have that recession on their watch. And until Reagan and Volcker, early in Reagan's first presidency, did that, and then that's what turned the tide and then gave us incredible prosperity. But you have to sort of take this bitter medicine. And it frustrates me a little bit because those guys, I knew last year that what they should have been doing, and it would have been better if they had, but I'm relieved they're doing it now. But the medicine's going to be a little bit more bitter. But having said all that, we will get through it. As interest rates go up, your bond funds, as everybody knows, have been getting brutalized. But if you own VBTLX, which is Vanguard's total bond market fund, or a bond fund like that with another firm, you have to realize that it owns bonds of all maturities, and at any given point, many of those bonds are maturing. And as the money from that comes in, it gets reinvested in new bonds at these higher interest rates. So your bond fund, while it's lost value in terms of its asset price, that value will come back slowly, but more importantly, you will have a higher and higher interest payment out of that bond fund. So if you're patient, things will work out. It's amusing to me that after in the days of high inflation, you also had very high interest rates on money market funds and bank savings accounts and everything. And of course, when they broke the back of inflation and interest rates started to come down, then the outcry was, well, savers are being punished because the amount of return they're getting on their savings account keeps going down. And of course, that's true. And that has been the case for the lifetimes of most of the people listening to us, is that steady decline of interest rates. And now it looks like they're going to go back up. And maybe one of the silver linings is that those traditional investments like treasuries and bonds and savings accounts that have been paying little or nothing in interest will start paying more. But of course, then you have inflation goes hand in hand with that.
So are you still a fan of the 4% safe withdrawal rate? I know there's been a lot of research in recent years. Kind of Morningstar came out with a report knocking it down to 3 to 3.5% recommended rate. In my own calculations, I use the 3%. And I've always been of the mind of just try to make a lot more money just to pad in order to hedge against any uncertainty. You still believe in the 4% rule? Is that something that people should be paying attention to?
4%, like any percentage, is not necessarily guaranteed because we can't know what the future looks like. If you want to be absolutely certain that you're going to be okay with your withdrawal rate, you should just own VTSAX and only withdraw the dividend, which is like 1.5% at this point, right? If you're really worried about that, but I think that would be a silly thing to do. I also think all the conversation around the 4% rule, it reminds me of about 400 years ago. There were theologians, and evidently these were serious discussions, who debated endlessly about how many angels could dance on the head of a pin. That's kind of how I view all this conversation around this 4% rule. Because in my mind, if you just change that word rule to guideline, you avoid all that angst. 4% is a terrible rule because that implies you can just lock this in place and leave it and forget it and everything will be okay. And of course, that's not true. The Trinity study showed that it fails 4% of the time in the period they studied. What you need to understand, though, is 4% is extraordinarily conservative. It has a 96% chance in that study of surviving for 30 years, and that's adjusting for inflation every year. That's a pretty conservative approach. That's a pretty remarkable thing. So if you think of it as a guideline in terms of how much money you need to throw off a certain income that you want when you retire, it is a brilliant guideline. But you should never take any percentage unless you want to just take the dividend off your stock fund. You should never take just any percentage and lock it in, start withdrawing it, adjust it for inflation every year, and forget about it. For two reasons. Number one is it might fail. Even if it's 3%, which I don't think failed at all in the study, there's always the possibility the market will do something that will cause it to fail. And the last thing anybody wants is to run out of money. But if you're looking at 4% or something less, the odds of it failing are really very slim. The real risk, it seems to me, is that the vast majority of times in that Trinity study with the 4% withdrawal rate, at the end of 30 years, you wound up with a huge amount of money, far more than you started with. And I can't imagine that you wouldn't have preferred to enjoy that money as you saw it growing. So that's why I say, whatever withdrawal rate you choose, pay attention to it. Obviously, if the market does something dramatically negative, you're going to want to rethink your spending and your withdrawal. But if the market provides a wind at your back, you might also want to rethink your withdrawal rate on the higher side so you can have more enjoyment and utilization of the money your money is creating for you.
How has your relationship with money changed since you started investing in 1975?
At this point in my life, and again, I'm a pretty old guy. I mean, I have more money than time. So I guess money has become less and less important to me as I've had more and more of it. I heard someone once say that, money is like oxygen. If you have it, then you never think about it at all. If you don't have it, there's nothing that is more important. So I have very little patience with people, for instance, who say, "Oh, money shouldn't be important in your life, and money doesn't matter, and you shouldn't put so much emphasis on money." Well, it seems to me that attitude comes from a great position of privilege and a lack of understanding. That might be true in your life. It's probably true in my life, but that's not the experience for most people. For most people, money is like not getting quite enough oxygen. So I suppose when I was younger, it was more important to me because I didn't have as much of it, and I was still building it, and I was still trying to figure out how to build it. And being a stock picker, there are some wonderful times. There are a few things more intoxicating when you research a company and you figure it out and you buy it and it goes the way that you thought it would go. But of course, that doesn't always happen. And there are brutal times when you do all that same work and you think you found the same gem and it leaves you bleeding by the side of the road. So there were those harsh things. And again, that's the beauty of indexing is you don't have to deal with those things.
Do you ever get the itch to buy any individual stocks, or is there like a secret J.L. Collins Robinhood portfolio that no one knows about?
So to answer the second part of your question first, no, there is not. But the answer to your first part is yes, all the time. I have what I call the disease, but I haven't owned an individual stock. Well, I think I probably got rid of the last one around 2013, 2014. But I'm constantly, because again, I spent a couple of decades doing it, and with some reasonable success. And, sometimes I look at things and I'm like, wow, this just really seems, pretty, I agree. But then I think to myself, the truth is that I would only commit a minor percentage of my net worth to any given stock. And so that means even if I get it right, it's not going to move the needle that much because I know how easy it is to make a mistake, even when you think you've done everything right. So I would never put so much in that it would move the needle negatively, which of course, limits. I mean, there's always more upside than downside because you can only lose 100%. The upside is theoretically unlimited, but in the real world, to have enough to unless you found something in the very early stages and wrote it up for multiple times. So it's just, yeah, I get tempted, but it's not part of my world anymore. I'm slowly recovering.
Yeah, I sold my last individual stocks late last year. The timing was quite fortuitous. It just took up some of my mind space that just wasn't worth the upside
Right,
at all. I just wasn't having any more fun doing it, and so I was
right.
able to capture some of those gains. What about crypto? So we're talking about this now at this in this crypto winter period. I couldn't not ask you about your thoughts. Having been a long-term investor, what are your thoughts on crypto?
My thoughts on crypto, which I'll share with you in momentarily here, today are exactly the same as they would have been last November when crypto was setting all times highs, right? So I don't invest in crypto. Crypto for me is a speculation. It's when you're buying crypto, at least today, basically you're buying something that has no inherent value. You are hoping that at some point in the future somebody will pay more for it than what you paid. So in that sense, it's very much like gold, right? So well, I guess gold has some industrial uses, but setting that aside, for the most part, gold doesn't have any practical use. It doesn't throw off any dividends. So when you buy gold or silver, all that kind of thing, you're buying it and you are hoping and expecting that at some point in the future somebody will pay more than you're paying. That's a speculation in my world, and I'm not a speculator. The other aspect, of course, of cryptocurrencies is the second part of that, which is currency. And theoretically, these things are currency, but from a practical point of view, and I know that there are some countries and companies that have tried with varying success to adopt them as a currency. But it occurs to me when you have something that is as volatile as cryptocurrencies are, it's very, very difficult to use them as a currency. This is the same thing, by the way, that makes inflation, especially hyperinflation, so dangerous. Is when you have hyperinflation, nobody wants to sell anything today because they know tomorrow they can get many more units of currency for what they're selling. And by the same token, buyers want to get rid of their currency as quickly as possible and put it in something tangible because they know tomorrow it will be worth less. Same thing with deflation, by the way, in the other direction, that's what caused the Great Depression. So what happens with rampant deflation or rapid inflation is the currency loses the ability to function as a trading medium, right? And it seems to me that's where crypto is today. Now, some point in the future, it could very well be a viable common currency. I don't know. But for now, it's a speculation, and I'm not a speculator.
Now, I want to get your thoughts quickly on real estate. You famously have very strong thoughts about real estate investing. I've chatted with my good friends, Christy and Bryce, about this. They're very anti real estate investing. I sit somewhere in the middle. I do think for the right type of personality, real estate can certainly accelerate your path to financial independence. I do have a lot of 22 to 27-year-old readers who own 5 or 6 properties and just live off the rental income and have done amazingly well with it. What are your thoughts on real estate investing?
Yeah. So first of all, I am not nearly as anti real estate as Christy and Bryce of Millennial Revolution. They are, and they're also good friends of mine. In fact, we were chatting with each other just yesterday, and they have a very intriguing post out, their most recent one that we were kind of laughing about. I have my second book is actually called How I Lost Money in Real Estate Before It Was Fashionable. And it's the sad tale of the very first piece of real estate I bought way back in the late 70s. It was a condo in Chicago. And if you had come up with a list of all the mistakes that were possible to make in buying a piece of real estate, I would have checked off all those boxes. So it's a cautionary tale, as the subtitle says. So I'm not opposed to real estate. I like you, invested in real estate when I was younger. And if you take the time to learn the business of real estate investing, and it is a business, and you're willing to invest your time along with your money in it, because you are taking on a part-time or for some people a full-time job when you invest in real estate. Even, by the way, if you hire property managers, because you have to hire and manage those property managers. So if that's what you want to do and you do it well, real estate, there have been many great fortunes that have built on real estate. Like you said a moment ago, there are a lot of people who go out and buy a handful of properties and they can live off the rents. So for me, if you're comparing it to investing in an index fund, you have to kind of think about it in terms of real estate investing is a bit of a hybrid. It's a part-time job or even a full-time job, and it's an investment. Whereas an index fund is just an investment. So the real comparison is, do I want to spend my time in the real estate business? Or do I want to invest in an index fund and spend more time on my career, whatever that happens to be, or just more time playing with my kids or whatever? That's a very personal choice. And when I was young, I spent some time investing in real estate. And after the first great mistake that I made that I wrote about, it was an expensive education, but was an education. And I did pretty well with the real estate. But I finally got to the point where it was just more work than I wanted to spend on it. And it was not the kind of work that I personally enjoyed. But yeah, there's absolutely money to be made in real estate. The final thing I'll say is I cringe when people think of their personal home as an investment, because I think that's a bill of goods that the real estate industry has sold to consumers. Your home's not an investment. It might go up in value. You know, if you happen to buy in San Francisco in the 1980s, yeah, you probably did really well. If you bought in Detroit in the 1980s, yeah, not so much. So I cringe at this drumbeat that you always make money when you buy your personal home. For me, and for most of my adult life, I've owned houses, I've owned homes, but I see them as a personal indulgence. I buy them because they provide the lifestyle that I can afford and that I want to have for whatever reason at that point in my life. But I never delude myself in thinking that I'm making some great investment. Now, sometimes the houses I've owned have gone up in value and sometimes not so much. But that's how I think about it.
Can you talk about how you've built a life you love and what your life looks like today?
I can't complain. I mean, it's life has turned out pretty well. I do think that a lot of it has been serendipity, to be perfectly honest, especially this phase of my life. So I had for my generation, a fairly typical business career. I happened to be in magazine publishing, business to business magazines. And because I started saving and investing early, I always wanted to have what I referred to as FU money, term I came across in a novel. Because I loved working. I've always liked working, but I throw myself into it pretty intentionally or pretty intensely, and I tend to burn myself out, and I don't like to do it all. I don't like working all the time, so I always wanted to have enough money that I could step away from jobs, and that's what my career looked like. Is I'd worked for a period of time, and I'd burn myself out, and then I'd step away and do a little sabbatical and then come back. And of course, in those days, that was not nearly as accepted as it is today. So I was always struggling with ways to fill the gap in the resume. It took a little bit of creativity, but so that was kind of my career. And looking back on it, and if I'd known the kinds of things that I know now about financial independence and reaching FI, and even the things like the 4% rule, a guideline of how much you might be able to spend. Sometimes I wonder if I would have done things differently. And of course, I don't know. But this phase of my life, writing for the FI community, which started in 2011, it coincided with that was when I quit my last corporate job, was the spring of 2011. And it was very coincidental that I started the blog then. And we said earlier in the conversation, I had no intention of creating a blog business. I mean, I had no concept that that was even a thing. And when I quit my job, I did it in the way everybody recommends that you shouldn't do it. I with no idea what I was going to do. I just decided I didn't want to do this anymore, so I quit. And that was the first time I ever quit a job, thinking I would never work again, because what was I
Mm-hmm.
would have been about 60 years old then, and I was, I just okay, this is it. And I'm every other job I'd ever quit, I kind of figured, this is temporary. I'm going to go back to work. But that one was permanent. But I never gave a single thought to what I was going to do. And then this sort of blossomed, as we talked about earlier in the conversation. I'm thunderstruck by how it's grown, and that it gave me a chance to create these events that we do every year now called Chautauquas, and to write a couple of books, and I'm working on a third now. None of that was planned, at least not at the beginning. I mean, as things progressed, as the blog took off, I thought, maybe I can create something where I can talk about this stuff, and maybe I have enough material for a book. So it evolved in that fashion. But yeah, I've been a very fortunate guy. It's worked out nicely.
So, what are your thoughts on the FIRE movement, or FI now, having seen it grow and explode really globally over the past 11 years?
Yeah, I think it's amazing. I don't track the actual numbers. My sense is that we are still unicorns. Now, that might not be so true today. I mean, certainly when I started writing about this, we were unicorns. When I was doing it, before the internet and the ability to connect, I was wandering in the wilderness. I had never met anybody who thought the way I thought about this stuff. So I think it's incredible. I mean, I'm in the same way I'm thunderstruck by the way my work has resonated with so many people around the world. I'm kind of thunderstruck that there are that many people who would be interested in what always felt to me like a very weird and unusual path that was certainly not accepted by the people in my immediate life when I was initially walking it. So yeah, I think it's pretty cool.
I'm always amazed at the international response. I actually laughed recently. I was looking at my Japanese book sales, and I know your book is in Japanese, and Christian Bryce's is in Japanese, and your book, just the reviews on yours are just so much more favorable than mine and Christian Bryce's. You're a celebrity over there, man.
I first of all, I didn't know that, and I didn't know about the reviews. I've done 15 international book deals so far, and about 5 or 6 of them have actually been published. And the Japanese version has been by far the most successful one.
Now, my book is in 14 languages, and you really paved the way. And it's been really fun to see, like, once you got picked up in Japan, then I got picked up in Japan,
Yeah,
and then I was in South Korea, and I think I saw you in South
yeah,
Korea. So it's
yeah.
really just kind of cool that, at least in those markets, consumers can have varying different viewpoints. If we ever have it in us, I was talking to Christy and Bryce about this once. We should organize a tour to South Korea and Japan, and just go over there and meet some of these readers.
Well, that's a brilliant idea. I think that would be a lot of fun. And I'm sure we'd especially if we did it as a group with our books all being published over there, I'm sure we'd receive a warm reception. I think commenting on the international stuff, the thing that amazes me is my book is very U.S. centric because I never envisioned an international audience, and I'm an American, and investing in the United States is what I know. That's where and 401ks and IRAs, and that's what I know. And it's amazing to me that my international readers have been able to take that U.S. centric work and apply it to their own unique cultures and countries. And the one that is most amusing to me is my book is published in Russian, and so it's published in Russia. Well, I am an uber capitalist. I mean, I invest in every publicly traded company in the United States of America, the beacon of capitalism. I am a diehard capitalist, and here my book is published in Russia, which gives me amusement and satisfaction. Interestingly, we sold the rights to China, and they've refused to publish it. The Chinese government has refused to let the publisher publish it.
Yeah, they'll get past that in China because mine also, they bought the rights and then it was on hold for about 2 years, and about a year ago it came out. So it's in mainland China. I saw you recently signed a deal with Harriman House, the publisher of Morgan Housel's Psychology of Money and Nick Majuli's book. Can you give us a little sneak peek on what the third book's about?
Sure, and our international conversation is kind of a good segue into that. Uh, I was mentioning that I'm kind of amazed at how my international readers have taken what I've written and applied it to their own unique situation. And by the same token, again, I wrote this book with a very specific person in mind, my daughter. And she was in college when I wrote it, so she was at the very beginning of her journey. And the book reflects that in a way it's written for somebody at the very beginning of their journey. Well, of course, now that it has a large readership, most of those people are not at the very beginning of their journey. And yet they have been able to figure out how to apply the principles in it, no matter what stage of life they're in. So a lot of those people have gone down a different path with different kinds of investments, and that maybe they need to unwind, or maybe they've gotten themselves deeply in debt and they're living too large a lifestyle that they need to unwind. And so how people and I've heard these stories from my domestic readers and my international readers on how they've taken my work and adapted it, and I find them absolutely fascinating and of course personally very satisfying. So that's going to be the gist of the new book. It's tentatively we're calling it Pathfinders, Stories from the Simple Path to Wealth. Yeah, and we're going to gather, and we've gotten, I think so far, 560 people when we put out the notice that we'd like to see your story. Now, how many of those people actually send in their stories remains to be seen. But my editor over at Harriman said, if all these people respond, we're going to have material for 5 books, which, by the way, I don't think we're going to do.
And you recently brought on a partner for the blog. Did you sell half of it, or how? What's that? I saw there was an announcement that maybe one of your friends or readers came on board to manage the business side. Can you talk about how that's worked out?
Yeah, sure. The short answer is it's worked out beautifully. We last spring, just about a year ago, I started thinking about selling the blog because I I just I've never enjoyed operating a blog. I'm not a technical guy, so the technical side of it, leaves me at a loss. I was fortunate a number of years ago to come across a guy by the name of Lucas who does the tech support for me, and he did a brilliant job. But then I've lived in fear of Lucas getting hit by a bus, right? So there were always, the operation. The only thing I enjoyed about the blog was writing on the blog, right? And So anyway, I started thinking about selling it, and Jay Money, who's a friend of mine, has got some experience in this stuff, and so he helped me and he sent it around, and we got a fair amount of interest for it, and but my concern was always putting it in the right hands, and by the right hands I meant somebody who would be a good steward of the work, because I do think, at the risk of sounding arrogant, the work's important, right? And I think we got so there were a lot of interested parties that we just excluded out of hand for those kinds of reasons, but we got some good interest from people that we thought would be good stewards, and I narrowed it down to I think two, and I was negotiating with these two different entities, and I'd never done this before, so I sent some of this material to two friends of mine who are very experienced entrepreneurs and business people, and that I have a high degree of respect for, who I think are more experienced and smarter than I am, and they both got back to me, and the one got back with very useful comments, and Sean, the other guy that I sent it to also got back with very useful comments, and we walked through all that together, and he sort of educated me, and then he surprised the hell out of me. He said, why don't I buy it? And
That's cool.
it was very cool, and I was thunderstruck because Sean's an extraordinarily wealthy guy, very successful guy, and my blog is a, a tiny dot. I mean, I said to him, Sean, I'd be thrilled to have you buy it. There's nobody that I would have more confidence in whose hands I would have more confidence in putting it. But I can't imagine why you would want it. I mean, if you took this and you made it 10 times what it is today, it would be meaningless against your other things. And, he was just like, I just respect your work. I just want to be part of it. I want to be the guy. I want to be the guy. And so, yeah, we went back and forth, and he made a very fair financial offer, and his big concern, in fact, the biggest sticking point was he kept saying, I want you to continue to be involved in working on it. And I kept saying, Sean, you do understand I'm selling this because I want to have less to do in my life, not more. so so anyway, we kind of resolved that, and so basically the end result, and then uh, Lucas went, and Lucas had told me, because of course he was involved in this process. Lucas said to me, "Hey, it's great that you're going to sell it, and I just want you to know, be sure you tell everybody that I am not going to be part of the deal." And he says, "I'm
Mm-hmm.
only doing this because of the respect I have for your work, but this is not something that I would otherwise want to do." But evidently, he and Sean met, and Lucas is now part of the new team. So there is a bigger team behind it. They handle all of the affiliate relationships. They handle all the tech stuff. All I have to do, strictly to the extent that I care to, is write on it whenever I want. It's still my blog in terms of personality and content. So yeah, I could not have asked for a better outcome. It's yeah, I'm very, very lucky, and we've been together. Let's see, when did we ink the deal? I think we inked the deal in early December of last year. So it's been about 6 months, and yeah. So because sometimes things that you think are going to be great turn out not to be as great as you think they're going to be. But this has turned out for me to be even better.
It's just a real pleasure and an honor to spend this time with you. And I've enjoyed learning from you and your spirit and following your lead and following your work, and look forward to future conversations. Thank you for taking time to be on the show. Everyone, check out jlcollinsnh.com to read JL's work. check out or buy a copy of The Simple Path to Wealth, arguably one of the best FI books of all time. Certainly influenced me even after becoming FI. It's a pleasure following you. Thanks for sharing your wisdom, and I hope you have a great rest of your day.
I hope you have the great rest of your day too. And as the Bobs would have said, the pleasure's all on this side of the table.
Thanks for listening to this episode. If you enjoyed it, please leave a review, and I would love your help getting the word out. Thanks again for listening, and I'll see you next week.